Hi there, Etoro. It is the first week of September, and so I'm going to take a look at my portfolio and the market performance through August. Let's take a look. On the agenda today, there will be a performance review. I'm going to look at the market influences. There were lots of them, so I'm just going to keep this to the headline kind of items. I'll talk about my portfolio changes and my outlook for the near-term future. In terms of performance summary, so there are a number of ways to slice and dice this information, of course, but on screen you'll see for my portfolio, the NSDQ100, the SPX500, and the ARK Innovation Fund, the returns from the beginning to the end of August, as well as the high that those ETFs reached and the lows. Now, all of these, the low number for each of these is the return for the month, just because the month ended on a downward spiral, a very strong downward sell-off. And then lastly, I have the Etoro lifetime. That's my lifetime on Etoro performance. That's from March 2015 until the end of August 2022. Now, I don't need to read through the numbers. You probably already have scanned all the numbers on screen, but you'll see that. But one of the most obvious things is that it was a very volatile month. So for my portfolio, there was a 12% spread. The high for my portfolio at one point was 8%, and I ended the month at minus 4%. The NASDAQ, another big spread between the high and the low. SP500, same thing. And the ARK Innovation Fund, even more so. One reason that I wanted to put the ARK Innovation Fund up here is because we got a taste of how certain stocks and ETFs will fly when the market does turn. So up at a high of 20% return, and I'm sure there were a number of people at that point in time kicking themselves, wondering why they hadn't got invested in ARK and seen some of that fantastic appreciation. Well, by the end of the month, you were being given that chance once again. Although I think that we will need to wait a little while now until we see such big gains. In terms of my commentary on the markets, so my portfolio slightly beats the ETFs that you saw on screen, but that is a bit meaningless to me. If you have a benchmark, your benchmark should be very similar in composition to your portfolio. You can't compare apples to oranges. Instead, my benchmark is just an average annual return. So over a lifetime of investing, I would like my average annual return over, let's say, 30, hopefully 40 years to be somewhere in the region of 25%. On Etoro, my returns are slightly below that at the moment. Obviously, we've had a very shitty year. Last year, I also didn't do fantastically. So I need a number of good years to push me over that 25% once again. Now, I think that the historical precedent is that we will have a number of good years. In fact, bull markets tend to run for 4 times the length of bear markets and tend to be 4 times larger in appreciation than bear markets. However, I don't think there's a bull market just around the corner just yet. I think that we need to work through a few more of our world problems before that happens once again. So back to my commentary, volatility remains elevated. You could see that in the ETFs that I mentioned. On screen on the right, hopefully you can see this chart, but these are all the sector-based ETFs in the US, so energy, financials, technology, etc. And you can see that they had a glorious ride, except for energy, through to about halfway through the month, and then almost everything closed the month down. Energy, though, it slumped initially, largely on the back of the fact that a global slowdown is coming. A global slowdown in demand means that less energy is used by industry and peoples generally. But by the end of the month, this view had returned, and energy has been influenced by a number of things at the moment. It's not just what the Fed says, it's also very political, it's also based on the war in Ukraine, etc. One good thing that has come out of the sell-off that happened in the second half of August is that it looks as though, and obviously we can't be completely sure of this, but it looks as though several quality businesses found a bottom somewhere in June. So there are some companies whose share price jumped 30, 40, 50, even 60%. And it was too much, too fast, especially given the economic situation we find ourselves in at the moment. And even though those companies gave a lot of that back through August, they still seem to be higher than they were in June. And this is part of the reason for my portfolio's outperformance of the indices that I mentioned earlier. Many Chinese equities have outperformed. The Chinese government keeps on adding additional support, stimulus, reducing rates in a number of areas for their market. And each time there's a little bit of an undoing of the market's optimistic sentiment, usually because they lock down another major city. But on the whole, Chinese equities did outperform the US counterparts, except for in certain areas. Real estate, obviously in China, is still battling, but other areas are showing relative strength. As I mentioned before, most US sectors declined through the month, so a lot of those gains given back, and I'll talk about why in a moment. and energy continues to outperform. And this is in part because of the price of natural gas, which continues to skyrocket, particularly in Europe, but also as the market tries to forecast whether demand is going to increase or decrease. So whether China comes online completely, then there's a big uptick in demand. Also whether supply is going to increase or decrease. You know, there are problems in certain refineries. Are new oil fields going to be founded? What are the political relationships between certain countries that supply large amounts of oil? So as I said, it's a very complicated picture, but at the moment we're in an energy crisis, and the prices, because of the lack of supply and the probable increase in demand for the second half of the year, are keeping those prices high. Now, if I had to summarize the one thing that had the biggest influence on the markets through August, it would probably be these two sentences. Investors were optimistic that a Fed pivot was only months away, creating a powerful rally. So the pivot here being that the Fed, they don't necessarily turn dovish, but they turn less hawkish. So they might not drop rates, but they start hiking by smaller amounts or hiking less as time goes on. However, the Fed put this expectation to bed at the Jackson Hole Symposium, that meeting of central bankers from around the world and famous economists, etc. So what were the market influences through August? Well, I have mentioned a few of those already. Let's start by looking at macroeconomics. So US inflation is still high, and I bet it's going to stay high for a number of years, but it does look as though prices are falling, so it's going to start drifting downwards. We saw the PCE number out of the US just before the Jackson Hole speech by the Fed chair, and that looked pretty good because the expectation was that it would drop from the previous reading, but it dropped by significantly more than what was expected. US GDP is definitely slowing. There's weakness in various areas. I'm watching the housing market very closely, mortgages, etc., because those tend to be leading indicators of the economic health of a country, probably 6 to 12 months out. However, there are other indications that the economy is holding up quite well in some other very important areas. One of those areas is US employment or unemployment, depending on which side of the coin you want to look. But the employment picture in the US continues to be very strong, and there are good and bad things that can be inferred from that. The good being that the economy isn't completely collapsing. If it was collapsing, you would see a lot more jobs being lost. But if employment continues to stay high, it means that wages come under pressure. And wages are a particularly sticky kind of inflation. If someone increases the wages of their worker, it's almost impossible to bring those wages back down unless there is a pretty heavy, deep recession. That means that there are layoffs and people are willing to accept less money in order not to be laid off. The dollar continues to be very strong, and the last time I made a video about the dollar, it was sitting at, I think, a 20-year high, and it's recently set a newer, higher multi-decade records. A very strong dollar has a number of negative impacts. There are some short-term positives about it, particularly in certain pockets and in areas of the economy, usually within the US. However, eventually, if the dollar stays too high for too long, it means trouble for the world, including the US. China's GDP continues to slow, so we had some downside surprises there. But on the flip side of that, the government continues rolling out new stimulus and economic support. The largest of these, there was an enormous package that was announced towards the end of August, together with additional rate cuts. Inflation in Europe is looking pretty bad, and I don't think that we've seen the peak just yet. The longer energy prices stay high, the longer that inflation continues to trend higher. Of course, high energy prices, I'll talk a bit more about this in a moment, but higher energy prices also increase costs elsewhere. It's not just the energy that's going up in price. Europe's GDP also continues to drop, and I'm including UK in this picture. So it's pretty likely, it seems pretty likely now that the UK is in a recession, and I'm sure that there are countries within the EU bloc that are also in recession now. It looks as though this weakness will persist as long as the current situation with energy continues. And emerging markets, there are a number of countries that are thrown together under the emerging markets heading, but there were a lot of surprises in some areas of emerging markets. A number of economists had said that emerging markets would suffer the most through the current economic situation that we're in, but it seems as though there are some countries that are managing themselves very, very well. Brazil is one such country. In terms of key topics outside of macroeconomics, so layoffs continue, and a large number of layoffs continue. But if you look at this diagram, which admittedly is just the number of tech layoffs, it looks as though the worst is behind us. Now, the caveat here is that if the US were to enter a protracted and deep recession, then I don't think the worst of these layoffs are behind us. But for now, they seem to be trending downwards, but there's still a hell of a lot of companies that are laying off. Companies are tightening their belts. I've mentioned it several times before. The energy crisis really is severe, particularly in Europe, but not isolated to Europe. There are energy shortages, prices soaring through parts of the US, through Asia, and in some of the southern hemisphere. This seems to be the most important topic for politicians through Europe and the rest of the world at the moment. As winter approaches, demand is going to increase, and people are worried that the prices are going to go so high that many people will not be able to afford heating, or they'll have to decide, do I want to be warm or do I want to have a meal tonight? Now, looking at other key topics, earnings season, it wasn't very good, but it wasn't very bad either. I know that something like 75% of companies in the SP500 beat their earnings expectations, but those companies had lowered expectations going into the earnings season. But there weren't a large number of horrific misses yet. The thing to bear in mind, though, is that the longer that high rates continue to exist, the more they will affect future earnings. Interest rates take a while to make their way through the entire market, and so next earnings season we will see more of the effects of the most recent hikes in interest rate. Shutdowns are also something that have been happening quite a lot, and this is tied to the energy crisis topic. But energy prices are forcing certain types of businesses to shut down. So there are some companies, for example, smelters, that use a lot of energy, and they can just no longer afford to run all of their factories anymore. One particularly scary area of the market that is being forced to reduce their output are fertilizer companies. So some of the largest companies in the world and in Europe are now reducing their output because the price of energy just means that they can't do business anymore. I have a feeling that this could create another crisis further down the line. The impact of this will probably only be realized in, let's say, 6 to 12 months, but hopefully we don't have food shortages. Fertilizers are key to making sure that the yield on our crops are sufficient to feed people around the world. There have been a large number of major weather events through not just August, but before that too. There have been droughts in the US, Europe, Asia. China's had a particularly bad drought. There have been floods and other major weather events. This is awful for the people that are living in these geographies, but it also creates a strain on power grids. So for example, if you need more aircon because it's super hot, and also almost all forms of electricity need water in order to be produced, not just hydroelectric dams, that's the obvious one, but almost everything else, nuclear plants, coal plants, electric plants, need huge amounts of water. And with all of these droughts and then major flash floods, water has become a very prized commodity. Talking about commodities, so most metals have been lower through August, but agricultural commodities have rallied a bit. They're still lower than they were a few months ago, but given the weather events and the shutdowns, I think that investors and other market participants are anticipating that the price of food is probably going to rise through the next year. When it comes to energy commodities, the prices have been a bit more mixed. So oil has been bumping around more or less the same level for a while now. But of course, as I've mentioned several times now, the price of natural gas has been going through the roof. UK politics has been another interesting topic through August. So we lost our Prime Minister, I think, towards the end of July. And so we had a bit of a rudderless ship through August. We now have a new Prime Minister. But given the cost of living crisis, inflation going crazy, soaring energy prices, it really was problematic not having a Prime Minister in the seat to make these big decisions. Now, that's changed, and hopefully we see some big movements within the UK government this month. And lastly, I want to talk about Chinese lockdown. So COVID-0 continues to wreak havoc on the Chinese economy, and China is incredibly important to a well-functioning global economy. So every time this happens, it throws a spanner into the works, and the government carries on doing things to try and stimulate activity within the economy, dropping the cost of credit, supporting those businesses that are on the brink of collapse, creating quotas in industries that they really need to grow. And yet every time this happens, it puts a huge brake on all of those efforts. I do not know why they don't just pivot on this one enormously problematic policy and would fix so many problems for them and also for for the rest of the world. In terms of portfolio changes, so I added some long-term positions in some companies that I think are a fantastic price right now. It would take me way too long to walk through each one and talk about my reasoning. Maybe I'll create another video about that. And I exited my position in Cineworld. I did mention this in one of my update videos. I really should have exited Cineworld when the court case against them, which would have been a few months ago, was initially announced. But I had thought that they would have a bit of a bumper summer when it came to movie viewings. That didn't happen, and so the company has said that it would likely file for bankruptcy. The company is carrying so much debt that even if it was rescued, it would mean that whoever rescues the company would probably acquire an enormous chunk of the shareholding in that business. I expect the dilution of current shareholders to be enormous. Maybe current shareholders get nothing whenever this deal is settled. In terms of momentum trades, so these are shorter term trades that I've made. So I entered and exited BP for a small profit, just as the energy stocks were completely hammered. And in terms of hedges, I have been short on the SPX500 actually since before August. I don't think I've added to that position. I've just held it through the whole of August. However, I did open a position in US long-term bonds. That position was there just in case the Fed did turn out to be slightly more dovish than people had expected, and that didn't happen, so I exited that position. My short positions on the NSDQ100, I think one of them hits a stop loss, maybe two of them hit a stop loss, and the other two were in danger of hitting their stop losses, so I did close those out. That's unfortunate because the market did drop significantly after that, and those positions would have been close to break even by now, given how far the market has fallen. This is the way that it goes with hedges sometimes. Most of your hedges you will find will not work out. They're not there to make you profit. They're there to offset the rest of your portfolio, and more often than not, there will be some cost involved. So in terms of my September outlook, inflation is the key data point for the Fed. This will decide what the Fed does next. I know that they were incredibly hawkish at the Jackson Hole Symposium, but if inflation were to trend down, I think we would see the Fed change its tune quite quickly. The next CPI print is on the 13th of September, and the market is going to be watching that closely. Winter is coming, and this has become a bit of a cheesy line, I know, within the media, but Europe is trying to offset price rises, and I think just today there have been many announcements about the various ways that countries are now looking to protect businesses as well as people from rising energy prices. There have also been a number of positive developments that have been going on in the background, and the media has been pushing these as much as the negative developments. These developments are things like Germany has built up its store of energy reserves enormously through the past summer or so that it can deploy these through the autumn and winter. France is bringing on, I think, don't hold me to this, but I think they're bringing online 30 nuclear plants starting in the second half of this year. Germany was going to shut down the last of its 3 nuclear power stations, and it's decided to keep them running. So there is a chance that the impact of this energy crisis through the second half of this year is going to be less bad than the media would have you believe. The ECB has also turned incredibly hawkish, and they've had to do this because rising energy prices have driven inflation to very high levels, like just about all other developing nations. Rate hikes, we're going to continue to see rate hikes out of major economies. In some case, those are going to be very aggressive. I suspect the Bank of England is going to be even more hawkish from now on. One of China's most important political events will kick off in October. There's already been some propaganda circulating, and I think part of why the government has been pushing all these stimulus measures and all these economic supportive measures is in anticipation of this event, so that the government's able to make all of these big, grand statements at this event. And retail season is coming. So the last calendar quarter of the year is very good for a number of companies, and that's because there are all the shopping events. It's not just Christmas and Boxing Day, there are also Singles Day, Cyber Monday, Black Friday, etc. And although I think people will probably spend less than they have last year or the year before on stuff, it will still mean an uptick for companies within this area. It's not just the companies that are making stuff, it's also the platforms that allow people to buy and sell things, it's also the payment platforms, etc. And the more seasoned investors will know that this is coming and will start buying within those areas ahead of Q4 this year. So what are my closing remarks for August? Markets were oversold in June, and there was a bounce when the inflation print came in and seemed to show a downtrend in inflation. There was a building anticipation that the Fed might pivot early, and I think that the market got a little ahead of itself. You may have noticed that the price action within the market has a way of affecting sentiment, even though the fundamentals might not support that sentiment entirely. And so we had a very strong rally through July, and that continued through August, started getting a little crazy through August, and then at the Jackson Hole Symposium, when the Fed said, listen, we're not going to pivot, we're going to keep at it, and we're going to hold those rates pretty high for a pretty long time, this reversed that rally. The thing to bear in mind, though, is that inflation does seem to be trending down. The US economy is also looking quite strong, despite the fact that the stock market is completely in the gutter, and rate hikes have been happening very quickly and will continue to come through the rest of this year. If we do see a downtrend in inflation, you can be almost certain that the Fed will start to become less hawkish, maybe not entirely dovish, not entirely optimistic, but less pessimistic about what it needs to do. In terms of strategy, so I remain patient. Sometimes what you have to do is sit on your hands. I've got a little bit of cash in my portfolio in the form of hedges, whether those are direct shorts on indices or perhaps holdings of companies in particular sectors that are hedging against the rest of my portfolio. When the time comes, I will free that cash up and spend the rest of it on the companies that I want to hold for the long term. Now, obviously, the question that everyone wants to know the answer to is, when will the outlook improve? We have a number of headwinds. We've got inflation, hawkish central banks, growth is slowing, there's an energy crisis, Chinese lockdowns continue. There's a lot of bad stuff that has been going on in the world and that looks likely to continue to go on for some time. But actually, the only thing I think that really needs to happen for the market to turn is for number 2 to reverse, and number 2 depends strongly on number 1. So if inflation has been trending down and we see the central banks changing their stance, then I would expect the markets would flatten out and begin to rally once again. Now, the thing to bear in mind is that a large part of the stock market is trying to price assets based on what they think will happen in the next 6 to 12 months. So the market is thinking about where will the world be from June, so next summer, through to next Christmas at the moment. And so you need to ask yourself, do you think the global picture will be better or worse by then? And you need to do this periodically. By the time we get to the end of 2022, they'll be looking further out, so beyond 2023 even. And do you think the world will be better or worse than it is right now in early 2024? All right, that's it for my review of August. I hope you found it interesting and useful, and I will speak to you soon. Goodbye.